We want to be in cities that are always progressing, that are always bringing in new business, that have good things going on. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and excited to be here today. So I hope you're doing well. One of the things I get asked a lot about is, I've been talking with investors, and I'm talking about specific markets. So we're in the Twin Cities market. That's our hometown. That's where it's easy to build relationships in. But we're also in Louisville, Kentucky. We're in Lexington, Kentucky. We're in Columbus, Ohio. We've done deals in Cincinnati. We've done deals in Memphis. We've done deals in Wisconsin. So we've done deals in multiple places. And over the years, I've learned a lot from doing deals in multiple markets and some things you got to be aware of. And the markets that I'm in aren't necessarily better than other markets in the country. I mean, they're certainly better than some markets in the country. But you have to understand, first of all, I think a big thing with picking markets, when I get asked, now, how'd you come up with that market? A big thing with picking that market is it's got to be a market that fits your investing criteria. It's got to be a market that actually hits what you're looking for as an investor, and think about the returns that you're trying to achieve, and think about your overall long-term strategy, what you like and don't like with real estate. So it's kind of got to hit those metrics. One of the things that we really like are markets that have slow, steady growth. We're Midwest people. We're just used to that. I grew up in Minnesota, but I've been here my whole life. I look for markets that kind of have that same story: slow, steady growth. Don't have big ups, don't have big downs, but just continue to have growth. We certainly don't want to be in markets that are, you know, Midwest is often referred to as the Rust Belt. We don't want to be in Rust Belt cities where it's decreasing population, where it's, just old manufacturing jobs or old jobs that are kind of going to the wayside. Like we want to be in cities that are always progressing, that are always bringing in new business, that have good things going on. But we also aren't looking for the markets that are big growth, big boom, big bust, right? So there's plenty of those markets out there, and we're seeing it play out in real time right now. We're seeing markets that have, over the last several years. I mean, there's Austin, Texas, for instance, for I think 3 years in a row now, has seen negative rent. And um, I believe they're currently leading the nation with like -7% rent growth, right? Phoenix, Arizona, negative rent. Now, would I just say those markets are never markets that I'll invest in? I actually wouldn't. Like, I would invest in those markets. Quite frankly, I would invest in those markets probably right now, today. Those are markets that interest me. Now, at the same time, we have to have things set up in those markets for it to make sense. So back to my criteria, a couple things I'm looking for, just to start off with, is, first of all, um, is it a market I want to travel to at all? Now, it doesn't have to be fancy. It's not like I want to travel to Lexington, Kentucky, because it's just this gorgeous place to be, and it's got all the things I love, and it's tropical and things like that. No, Lexington's a nice city. I like it. I enjoy it. There's nothing wrong with it, but it's not like it's like a vacation destination for me. But it's a nice, clean city. It's a market I like to go to. It's got very friendly people. It's got very good business. It's, like I said, it's clean. It's low crime, like the things that they're checking the boxes. We're so that's a big thing. Another thing is, how easy is it to get there? So can I get a direct flight to the market? Now, Lexington is really actually a little bit challenging, but Louisville and Cincinnati I can get direct flights into, and Lexington is just an hour away. So we've been okay with Lexington because we've got properties in Louisville, and we can get a direct flight to Louisville, check out our properties there. A 1 hour drive, which is kind of a pain, but a 1 hour drive that I can get over to Lexington. Um, Columbus again, I could fly direct flight into. I don't want to be in a market where it's really hard or really expensive to find flights and I can't get in and out. I really like markets that I can get in and out of in the same day. To me, that's extremely valuable. And as you get farther in your investing journey, and if you got more deals and you get busier, like that's even more and more valuable if you got a family, all that kind of stuff. You want to get in and out. So how easy is it to travel to? And then is it a market I see myself continuing to be in for many, many years? I don't want to just jump into a new market. And that's something like, as I said, like Austin, Texas is a great market to get into. Yeah, Phoenix is a great market to get into. Yeah, there's probably some good opportunities right now, right? A lot of people were buying there in 2021 and 2022, and they've been getting slaughtered over the last several years. So there's probably some desperate people there that need to get rid of their properties, and you might be able to get a good price. But is it a market I see myself in many years? And is a market we feel like we've got a good team in and continue to grow in? And do we want to continue to be there? And those are the questions you've got to ask yourself with those markets. Beyond that, um, a couple must have. So here are the basic must haves. First of all, you got to have cash flow. You've got to be able to find markets that have good, solid cash flow on those markets. And so again, pick on the Austin and the Phoenix, and a lot of the Sun Belt markets, a lot of the South markets, a lot of the West markets, right? These markets were markets that were super hot, but you couldn't get any cash flow on those markets. And for me, that doesn't work. And that's why I like the Midwest. I can get cash flow. Okay, so cash flow is number one. Can I cash flow on these buildings? Can we actually make money on a monthly basis? Um, Number two, this is very specific to the market and submarket, but is a well located asset. Can I find well located assets in that market, or all the properties that are being brought to market in like terrible neighborhoods, places I don't want to be? I really, if I pick a market, I'm looking at the big fundamentals, overall fundamentals of the market and overall fundamentals of the state, but I'm really diving into the submarkets within that. Because, for instance, in the Twin Cities, we've got Minneapolis and St. Paul, but that's not what the Twin Cities are, right? Minneapolis and St. Paul make up a big part of it. We also have a lot of suburbs around. We just bought in a suburb called North St. Paul. A lot of people think, oh, that's the same as St. Paul. No, it could be actually more different. Um, so you have to understand the specific submarkets and what's going on with those submarkets. So it's a well-located asset in a good submarket that really has good fundamentals going on. So can't just focus on the city. Got to focus on the city, but then the submarkets within the city that we really want to be in. Um, does this market have low new inventory? So the big problem that's going on, again, playing out in front of us right now, are a lot of these Sunbelt markets, a lot of the southern markets, the Texas markets, the Western markets, like the Phoenix and a lot of these mountain markets have had a ton of new inventory. And they've got so much new inventory that they can't even keep up with it. And so then we're seeing these rent declines, and we're seeing huge vacancy rates. I just saw something the other day, and I didn't fact check it, but that Dallas, Texas has got an occupancy rate of 87%. That's 13% vacancy. That's pretty big. Again, I didn't fact check it. Maybe it's wrong, but that's what I saw. I don't want huge inventory coming into my market. I want to make sure my market isn't consistently having that. And so I'm looking for markets that have a track record of deliveries, but not overabundance of deliveries. Um, Rent affordability. Here's another big thing. I look for markets that have good rent affordability. Landlord friendly. Okay. Are they landlord friendly? Now, Minnesota is not a great landlord friendly market, but it's not terrible. A lot of people will think, oh, it's a blue state. It's going to be terrible. It's gotten worse, certainly since COVID. So that's not exciting, but it's for the most part not a terrible landlord market. Now, the sub markets can be. So if you're going to invest specifically in St. Paul or specifically in Minneapolis, those are much worse, right? St. Paul has rent control. Minneapolis potentially will have it. So if you're specifically in those two cities, certainly it's a lot less landlord friendly, right? We're in Kentucky, fairly landlord friendly state. Ohio, pretty decent as well. If you're in Texas, if you're in Florida, fairly decent landlord friendly markets. If you're in California, of course, that's not going to be the case. So I like landlord friendly markets. That doesn't mean it's a requirement. Maybe you're okay with the opposite, but I like markets that are pro business, that don't hate landlords, and don't see them as bad people. I want markets that are, going to work with me. And of course, uh, you know, any market's going to be hopefully any market's going to be anti landlord if you're a slumlord. But if you're a good owner and you're doing good things with your residents, then I don't see why they should be an enemy of you. So that's what we look for, landlord friendly. And then, we look for appreciated markets. Appreciated markets, got to have good job growth, got to have good population growth, all those things. Another thing, like I've talked about, I live in the Twin Cities area, and that is when I go, where do I invest? Do I invest in my own backyard? Do I invest in other markets? There's a massive advantage of investing in your own backyard because you should be able to get to know it way better. Now, a lot of people are lazy and so they don't get to know it way better, but you've got to get to know your own submarket better. And it's easier to get to know it better because I can take trips every single day. I can, drive by these areas quickly. I just bought a property, and Durris just bought a property that is located literally like 4 miles from my house. Since we bought that property, I'm there all the time. I go a lot of the stores. When I go to stores, I'm literally driving almost right by this property. So it's easy for me to swing by. A lot of times I just literally just drive through the parking lot and just keep on going. And so it's very convenient to be in your own backyard. We are also at Endurus trying to build more of our management company, more of our construction company. So we're trying to grow those areas to be bigger, to be better, to be just more vertically integrated. It's easier to do that when it's in the market you live in, and then building broker relationships, right? Endurus is trying to build good, solid broker relationships so we can find the best deals. It's easier to do in markets that you can connect with the brokers quickly, easily. We've done extremely well in other markets, right? To connecting with these brokers, but it's just easier when you're there. All right. So the basics. Here are the basics. Median income level. We like median income level to be at least household income to be at least $60,000, potentially higher. We like B class markets. Now, this is just our preference. You might say I like C class. You might say I love D class. I don't know, but we like B class or A class submarkets. So we want submarkets with a pretty decent income, and we look at 60,000 is just kind of a marker, right? It's not hard and fast. We look at what's going on in the overall city itself. So if the household income in the city is average household income in the city is, 52,000, well, then maybe we're okay with going down to that 52,000 mark. If the average household income is 75,000, 60,000 might be a little too light for us. So population growth, it's got to have population growth. Really, I put in 5 miles here, but really it's got to have population growth within a mile. Like I want to make sure that population is growing within a mile, within 3 miles, within 5 miles. I want to see that the population is actually growing and not going the other way. Same thing with job growth. Like I want good job growth that's happening in the area. What are my main drivers too? Like I want to have a couple big drivers, and then I want to have some of the other things going on there. And so I want to have like the property we just bought. There's 3M very close by, right? That's a big driver of potential residents, right? There's some hospitals really close by. There's retail shopping and all kinds of different things. There's a lot of jobs within a 5 mile radius, 3 mile radius, right? You can get to downtown very quickly, downtown St. Paul, downtown Minneapolis very quickly. So, uh, do they have solid schools, right? Are the schools that nobody wants to go to? Parents are trying to send their kids elsewhere, or are there good schools fairly close by? Is there government support in the area? And I don't mean is the government doing handouts to people. What I mean is, are they proactive in the community with trying to bring businesses in, with trying to improve, the streets and just the overall feel of the community. So again, it's not about are they giving handouts to people, but are they building a better community, bringing in better businesses? Are they advocates for their own neighborhoods? And then we really look at the neighborhood housing stock. We want to make sure that's in a really good condition, because if the neighborhood doesn't care about its own houses, that means I'm going to have a really tough time finding good residents in that area. It's just really tough when everything around it's run down and just doesn't look good. And that goes along with the city, right? The government. If there's no government support in the city, the streets are in bad condition. There's poor lighting. There's trash. It's just run down. It's really hard for me to have a nice property there. Here's one of the things I really I've made this mistake, and I've gone to cheap submarkets, to cheap properties, and cheap markets are not typically the good markets. Look, it's easy to go, man, that those properties are cheap, these houses are cheap, I'm going to buy here. But cheap typically doesn't mean good, right? So cheap properties I've fallen into this trap. I buy the cheap house. I buy this, I look back at the Great Recession and I say, I bought these houses for $60,000, right? Buy this house for 50, $60,000. And I did okay, right? I mean, I rented them, I made good money, and I watched the houses appreciate. And the $50,000 house turns into a $200,000 house, and I sell it. Great. I made really good money on that. Probably put some money, not probably, I did, put some money into it. And so maybe it was all in at 75 to 100,000, and I sell it for 200,000. Okay. So I make 125 grand. That's great in call it, 5 to 7 years, 10 years. But I look at that and go, well, what about the properties I bought in better areas or should have bought in better areas? I watched those properties and maybe I would have spent $100,000 to purchase them and another, 25, $30,000 to fix them up. So I'm all in for double the cost. But instead of those increasing to 200,000, they increased to 400,000. So now instead of, making 125,000, I make $200,000. And that's the difference between a good neighborhood and a bad neighborhood. And I watch these bad neighborhoods, they take, 7, 10 years to appreciate and get back to where they were. And I watch the good neighborhoods and they take 1 or 2, maybe 3 years to appreciate and get back to where they were. And then all of a sudden they're worth way more very quickly. Same thing with the rents. I watch the rents in these poorer neighborhoods, go from 1,200 to 1,300 to 1,400, and I watched the rents in the good neighborhoods go from 1,500 to 1,800 to 2,500 to 3,000. And it's like, wow, the growth is much quicker. It comes earlier in the better markets. So the other thing too is, as you look, 5%, let's just look at this 5% growth on a property that's worth $100,000 a unit versus 5% growth on a property that's worth $50,000 a unit. There's a big difference there. And now this is typically not even the case, because that property that's worth $100,000 a unit versus 50 is usually going to appreciate even faster. So it's, instead of just 5% growth, maybe the property that's worth 100,000 goes at 5% growth, but the property that originally is worth 50 is likely only growing at more like 3% growth. But we'll use the same percentages for purposes. So in 5 years, the 100K property is worth 127 a door. The 50K property is worth 63,814 a door. So if you got a 200 unit building and you buy that at 100K a door versus 50K a door, you're going to make an extra $2.76 million dollars in profit in 5 years. And that's assuming we've got the same cap rate at purchase, we've got the same appreciation. That's assuming those things. So you can see how quickly the a little bit more expensive properties, again, they have to hit the fundamentals, but they can create a lot more income quickly. All right, so job creation. Look, I love jobs that span the market. I want the white collar jobs, I want the blue collar jobs, I want everything in between. If I've got white collar jobs, those white collar jobs bring in blue collar jobs. They're going to shop at the grocery stores. They're going to eat at the restaurants. They're going to bring in, more jobs as well. And so, all if I've got jobs spanning the market, we're really bringing in a lot of people. Those create more jobs. And I like a diverse industry, right? I don't want just. I mean, think of Detroit, right? Had a great economy for a while until things changed in the automotive industry. And then what happened? Well, we all know the story of Detroit. It very quickly went down. Population decreased rapidly. Crime spiked. It just major issues. And they're still fighting out of it to this day. I think I saw a statistic. Detroit had its first population growth in over 50 years. I think it was over 60 or 70 years, in fact. Um, and his future growth is expected, right? And so again, what's the Chamber of Commerce doing? Is there good state incentives? Is there good city incentives? Like, what are people trying to do to bring in jobs, bring in, you know, population, right? Bring higher pay scales to the market. So, all right. Of course, we're looking for population growth, and this is an old chart. I need to update this, but you know, where's the population growth? What cities are growing? So first of all, you want to make sure that the city you're investing in is growing, and then you want to make sure there's a path of progress within that city. Okay, well, there's always a path of progress. So, for instance, if you look at um, the Twin Cities, right? The west part of the Twin Cities in general has the higher population growth. If we take the city of Minneapolis and we go southwest, that's going to be your greatest population growth. That's the path of progress to the southwest, to the west and southwest. Now, there's pockets to the east. Okay. There's pockets to the north. There's pockets to the south, right? But the main path of progress is there. So okay, let's really focus in on those markets, and then let's look at some of those pockets too. But we want to make sure we're looking for the path of progress. Um, Again, crime rates. Really, I pay a lot of attention to crime rates. I don't want high crime areas. It just doesn't work for me. Schools, you got to have schools that are in high demand. That's going to bring people in. That's going to keep people there, right? Areas that are gentrifying, watch for those too. Like if you like the urban cores, watch for the areas that are gentrifying, the arts districts, the people that want to move in, the think of the young people that are just graduating college, want to move into specific areas. So if you like the urban cores, really looking out for some of those. One of my better duplexes I ever bought was in an area called Northeast Minneapolis, very arts district area. And I bought this property. And it's right across the street from a proposed new development that went in about 4 years later. And my rents from in that sub market, great area, great growth, gentrifying area. My rents went from $700 a month to now I'm getting like 1750 a month. So they exploded, and it's because of the gentrifying areas. Um, Areas that have tighter restrictions for development, or areas that just don't have this major development that's always happening. And then I also like larger populations, MSAs with 500 plus people. I like that because I like to make sure I have people I can hire. I like to make sure I have services, that contract services that I can have, people mowing the lawns, people doing the maintenance, all that kind of stuff. Pay attention to the permits that are being pulled currently, that are pulled, and then being pulled in the future, and then look for the absorption rate in the market. Can we absorb these all these properties that are coming online? Look for vacancy, right? And what direction is it trending? If your vacancy is trending upward, okay, well, why is it trending upward? And is it can continue to trend upward? There are a ton of, permits being pulled, and there are a ton of buildings being built. I mean, you just Google crane watch in the specific city you're in. Like how many cranes are happening, and that's exciting, and it could be a good thing, but we want to make sure that we're not developing too many new units for the market, and everybody's just over exuberant. I've talked about the government planning, but is your city or nonprofits bringing the business in, right? Is there a comprehensive plan within the city or the neighborhood? Like, what are they doing? What are they doing to improve things? And where are they improving things? If you see that there's some cool things going into the market, that could really make a business case for specific properties or redevelopment of properties, right? Is it easy to move to? Is there anything to do in the city? Do people want to move there? And then think about the tax structure for businesses, for residents too, but for businesses. The other thing too is like, and it's not on this slide. I guess it doesn't pertain to this slide, but what kind of education level do the people that are living in this market have? I think that's important too. Rent affordability. This is a big one. Rent has become unaffordable for a lot of people. Housing has become a lot unaffordable for a lot of people, especially with interest rates driving up, and now we're sitting around 8%. Like, housing is a big problem, and so is rent affordable? Look, I want the median area income to be at 30%, the rent to be at 30% of the median area income. And I really would like it to be more like 20, 25%. So tenants really should pay no more than 30 to 30% of their income to rent. So you want to make sure that you've got tenants that can afford it. And if they're paying 35, 40%, that's really tough to keep on going, right? And so that's a market, in my opinion, that you might have to actually drop rents in. So I want rent affordability in the market I'm looking in. I want to make sure it's possible there to continue to raise rents. I want to make sure it's possible to continue to pay my bills, of course. And if I can't raise my rent, sometimes I can't pay my bills because my bills are going to continue to go up. I mean, insurance costs are going to continue to go up. Real estate taxes are going to continue to go up, right? Payroll is going to continue to go up. But if I can't raise my rents, I can't pay my bills. All right. We've already really talked about this. What's the absorption rate? How quickly are things being rented? Vacancies. I want to make sure that we've got low vacancy rates. Just compare it to the historical and what's going on in the market, right? And what that market is seeing. I like markets that don't have huge swings. I want to see that. If we're 95% occupancy today, is that market typically at 95%? Or does the market swing from 85 to 95 and it bounce up and down all the time? Right. I want to see that it's fairly steady. Maybe we have 5% vacancy today, and 5 years from now, or 5 years ago, we had, 4.2% vacancy, and 5 years from now, we're expected to have 4.8% vacancy. Like, I want to see markets like that. I don't want to see markets that are at 85% occupancy and then they go to 95, and then they go back down to 90, and then they go up to 96, and then they go back down to 80, 84, and so on. I don't like that yo-yo effect. Here's a big one. If you have no opportunity to purchase in a market, if there's just very few sales happening and that fit your criteria, probably not a market you want to be in. So make sure that the inventory is even there. So the inventory for sale is important. Make sure you understand your criteria and how that fits into the market. Is it even possible? So talk to brokers and talk to lenders and find out what's going on in the market and identify, is that even a market you can buy in, right? Understand what you're looking for. Maybe you have to slightly adjust for your criteria, but man, if you want to buy newer buildings that are built between 1980 and today, and And there's no buildings built between 1980 and today. They're all 1940s builds. Like that's a big criteria adjustment. I don't know if I do that, right? If you want to buy 200 unit buildings and the every single building in the markets that you want to be in, the market wants to be in is 40 unit buildings. Well, that's again, that's a huge adjustment. And so I would make sure the market has inventory, has properties you can purchase, and they actually fit your criteria. All right. So that's kind of what I look for in a market. There's a lot to look for, but the big things I want to see is does that market have just solid fundamentals, right? Good job growth, good population growth, a city that is really trying to progress forward in business, bring new companies in, and try to stay ahead of or with the industries and with what's changing in the economies. And I want to look for cities that are easy to travel to, easy to do business in, and want to do business with property owners, right? That's what I'm looking for. Another thing I've seen too, and I think this is something big to pay attention to, like in Memphis, Tennessee, for instance, it's just pretty common for tenants not to pay their rent, and it's almost acceptable. So that's another thing I want to see is like what kind of bad debt is going on in the market. In the Twin Cities, people pay their rent, right? Not everybody, but 98% of people pay their rent. Where a market like Memphis or Atlanta or some of these deeper South markets, mid South markets, it seems pretty common that 92% of the tenants pay their rent. Well, that's a big difference. So if I want tenants that pay my rent, I don't want markets that just are like, yeah, it's no big deal. I don't need to pay. I'll just go on to the next one. That is not the attitude I want. So those are markets too that you got to be careful in. You got to understand, okay, I can have 95% occupancy, but what does that actually mean? Do people actually pay me? Do they actually show up with the check, or are they just renting and taking up space and going to be a problem that I'm going to have to evict in the future? So lots of things to think about when you look at a market. First thing I would say is invest in your backyard before you start investing somewhere else. Before you give up on your backyard, don't just say, "Oh, I like this market because it's shiny." Really, backyard is best before you go somewhere else. All right, that's all I got for today. I'm Todd Dexheimer signing out. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.